You're now listening to episode 111 of the Real Estate CPA podcast.
Your source for all things real estate, accounting, and tax. Here we reveal our secrets that can save you thousands in taxes, streamline your accounting process, and help grow your business. Stay tuned to hear insightful interviews with industry experts, successful real estate investors, and current clients on what strategies they use to grow their business and how they steer clear of Uncle Sam.
Hi everyone, thanks for tuning in. Today's episode is taken from a recording that Kim Lisa Taylor of the Syndication attorneys and I did where we discussed the tax treatment of carried interest and other fees that general partners of real estate syndicates and funds receive. Carried interest, also known as sweat equity, a promote, or a profits interest, is the portion of a deal that a general partner or sponsor receives for putting together and managing a deal on behalf of their limited partners who invest passively. In other words, it's the GP's share of that 80-20, 70-30, or 60-40 split for running the deal. This recording was originally posted on the Syndication attorney's website for replay, and that link can be found in the show notes below. With that being said, let's jump right into today's episode.
Excellent. Okay, so let's just dive into the questions then. What is carried interest?
Great. So carried interest, sometimes called carry, is a share of the profits of an investment paid to the investment manager. In our case, most likely a general partner, as many people call it in this industry, in excess of the amount the manager contributes to the partnership. This is very common in the real estate space. So this is also known as a profits interest. And it's basically just compensation for ensuring that the limited partners achieve a return on their investments. And the carry, for example, would perhaps be, let's just say that, there's a split to make it simple, a split where the general partnership or the managers, they get 20% of the share of the investor LLC for making the property, for putting the deal together and managing it, while the investors receive 80%. And that would just be an example.
Sure. So back to our picture that's on the screen, you'd have Class A members owning 80% of the company and Class B members owning the carried interest, and that would be the 20% of the company. So another name for this would be promote, or sometimes it's the carve out that the manager entity earns. So carve out, promote, profits interest, carried interest, in the tax world, they all pretty much mean the same thing, right?
Yeah.
Yeah. Okay. So we've kind of covered that the Class B interest is where this carried interest typically occurred. Now, could you just have members and a manager and still have the same structure? Sure. You don't have to have the Class B members. We just like it because we like to give the Class B members some different rights than what the manager has, and we like to make that distinction. So just in case you guys hear something chewing in the background, I have a puppy who might at some point join our call. So what does ordinary income tax mean and what triggers it?
A great question. So ordinary income tax is simply income that's taxed at the ordinary income rates of 0 to 37%. This ordinary income generally includes wages, business income, also sometimes called self-employment income, rental income, interest, and royalties. Very common income types that are taxed at ordinary income tax rates.
And does that include, the self-employment tax?
Yeah, so basically when you own a business or you're self-employed, the first $137,000 of your income is taxed at a rate of, it has an additional tax rather called the self-employment tax, which is 15.3%.
So if you're earning fees from, so let's just talk about this. So the ordinary income tax, with the self-employment tax would apply to certain things in a syndicate, but there's other things that might not apply to. Is that correct?
Yes. So when you're dealing with a syndication, if the general partner or the manager, they receive acquisition fees, disposition fees, refinance fees, asset management fees. This is all considered ordinary income and is taxed at the ordinary income rates of 0 to 37%. And in addition, as in most structures, it's also going to be subject to the self-employment tax as well.
So the self-employment tax would be in addition to the 0 to 37% that somebody is already paying?
Correct.
Okay. All right. So manager's fees. So that would apply to all manager's fees. What about cash flow distributions that are paid to the Class A members, the investors?
Yeah. So cash flow. So you're not necessarily taxed on the distributions necessarily. You're taxed on the rental income that's allocated to you. So to give it a quick example, if there was $100,000, let's just say, of rental income, and the Class A members, the investors, were allocated 80% of that, so $80,000, they're going to pay ordinary income tax rates on that $80,000. However, that said, there's usually depreciation and different types of expenses that cause a loss. But if there were to be rental income, it's going to be taxed at the ordinary income tax rates.
Okay. And what about how are the Class A members taxed on distributions they receive from equity on sale of a property?
Capital gains. It's going to be capital gains tax.
So we've kind of just explored what ordinary income tax is. Let's explore what capital gains tax is.
Absolutely. So capital gains tax is the tax on the difference of the sales price of a capital asset, such as real estate, and its adjusted basis, which is pretty much, long story short, it's purchase price less the depreciation that was taken on that asset during the time you held it. Again, it's a tax on the sales price, basically the tax on the gain from sale of capital asset. And if you hold the asset for a year and a day, then longer than a year. So a year and a day or longer, you're going to be taxed at the long-term capital gains tax rate, which ranges from 0, there's 3 rates. There's 0. So I forgot the exact number. I think it's like $19,000. If you're making less than $19,000 a year, you're getting taxed 0% on your long-term capital gains. Very rarely do we see that. But if you're making between that rate, that number, and $434,000, give or take, if you're single, you're taxed at 15%. And if you're above that $434,000 rate, if you're single, or $488,000 if you're married, the capital gains tax rate is 20% for you. So that's the long-term capital gains. Now, if you hold the capital asset for less than a year, then you're going to be subject to the short-term. It's going to be considered a short-term capital gain, and short-term capital gains held less than a year are taxed at the ordinary income tax rates.
Okay, so that's going to apply if someone's doing a single family fix and flip fund and they're turning properties in less than a year.
Yeah, and something to watch out for, and not to get too deep into the weeds there, but when you're flipping properties or you're developing properties, there's certain criteria that may classify you as a business, and your properties that you're flipping or developing are no longer considered capital assets in the eyes of the tax code, and it's considered inventory. And thus, when you sell that inventory, your profit, or what would otherwise be considered a gain, is taxed as ordinary income at the ordinary income tax rates, and can be subject to the self-employment tax as well.
Okay. What about Class B members? So if the Class B members are getting cash flow distributions, how would those be taxed?
So when you receive your carried interest or your profits interest, the income that you receive from your share of the interest retains its character. So if you were to receive rental income, it's going to be taxed at the ordinary income tax rates. Now, if you were going to receive, so that's the distribution. Yeah, it's taxed at the ordinary income tax rates.
And then what about a Class B member that receives a distribution from equity earned on the sale of the property?
Yeah, so that's a great question. So there's a big debate in the community, the tax community, how this should be handled. But the way it is handled is that the carried interest, if you after the Tax Cuts and Jobs Act of 2017 was enacted, they changed the section of the tax code that dealt with this. That if you have a carried interest, you need to hold any asset within your carry. Basically, any asset needs to be held for longer than 3 years, for at least 3 years or longer, in order for you to get the long-term capital gains rates on that. Otherwise, if it's held for less than 3 years and you have a carried interest, then it's going to be taxed at short-term capital gains rates, which is it's going to be taxed as a short-term capital gain, which is taxed at the ordinary income tax rates.
Okay, so short-term capital gains less than 3 years for the Class B members, their sweat equity portion, their carried interest is going to apply for any asset that's held less than 3 years.
Correct.
And the long-term capital gains rates is going to be applied if you're holding it for longer than 3 years.
Correct.
Okay. So from a tax perspective, if the manager is earning fees that are taxed at ordinary income rates, and then there's a chance that at some point within the life of the syndicate that they're going to earn some equity that's going to be taxed at the long-term capital gains rates, does it matter that the manager, from a structural standpoint, can the manager get taxed at two different tax rates for its earnings?
So if the manager's receiving like ordinary income from it in the form of fees, then yes, it's very possible for them to be taxed at the ordinary income tax rates on their fees and taxed at at capital gains rates on any capital gain that they have from the property.
So is it okay, or is there any reason that the manager itself shouldn't just be the Class B member versus, maybe having the members of the manager be the Class B members instead?
Yeah, so this is another great question, and like not to get too far into because I could dive down a whole entire rabbit hole here, but to keep it short, when you structure, when you're receiving, so what some managers like to do is they might be considered what's called a real estate professional for tax purposes. And if you're a real estate professional for tax purposes, the losses you receive from the losses you have from your rental activities can offset your ordinary income. Generally speaking, losses from rental activities are considered passive and can only offset other passive income. So I personally want to sign on the loan. And the reason for this, if you're getting qualified non-recourse debt, with the qualified non-recourse debt, basically it increases your basis in the partnership because you're signing on the loan. And when you increase your basis in the partnership, it allows you to take the losses. Because what ends up happening is the Class B members don't really put in much capital, or if they do, it's very little. And that prevents them from using the losses. So let's just go back. If we go back to our 80-20 example, right? 80% of and say there's an investment loss. So it's a $100,000 loss the first year the partnership's in operation, or the deal is going on. 80% of the losses are allocated to the partnership, to the Class A members, 20% to the Class B members. The Class B members don't have any basis in the partnership, or have a very little basis because they didn't contribute any capital. So what's going to happen is that's going to create, basically it's going to bring their capital count below zero, and they're going to be unable to take the losses against their active income.
All right, so I'm sure we're going to get some follow-up questions on that one, but those are some pretty advanced strategies. I knew I was going to learn things on this call, so I'm super glad that we're having it, but I am not going to try to give people that kind of advice. I'm going to send them to you. So, all right, so let's talk about how all of these different income sources are reported. When does somebody within a syndicate get a 1099 versus a K1? So let's start with how are you going to report taxes? Well, first of all, what is the difference between a 1099 and K1? Let's start with that.
Okay. Yeah. So a K1 is basically partnerships and S corporations, but in our case, it's focused on partnerships here, don't pay taxes on their income, right? So the partnership files a partnership tax return, Form 1065. And then Form 1065 reports, hands out K1s to each partner. that reports the partner's share of the income loss deductions credits of that partnership. And then the individual partner pays tax, that will file that K1 with their individual tax return, 1040, and pay tax based on their individual circumstances. So, you know, and at 1090 first, when it comes to a 1099 is, in this case, a 1099 MISC. It just reports basically reports business income that's paid to somebody. So, for example, with 1099, if I were to go hire an independent a contractor to go do work on my property, and I'm gonna give them a 1099. That's how they're gonna get a 1099 filed for that income I paid them.
All right, so let's see where these different tax reports fit into the syndication structure. What would you give a manager LLC? Would that manager LLC receive a 1099 from the investor level LLC or a K1? If all they're earning are fees.
So the manager LLC, the manager LLC in this case doesn't own anything, right? It's just the manager. Just the manager. So yeah, so the fees, it would be a 1099 from the investor LLC to the manager LLC, and then the manager LLC, assuming it's a partnership, it would then give K1s out to each of their individual partners.
Okay. So what if the manager LLC also owned the Class B interests? Would it receive a K1 and a 1099?
So in that case, it should receive just a K1.
And the K1 is there a way on the K1 to characterize which income was paid for fees versus which income was paid for share profits?
Yes. So generally on box 1 of the K1 is going to have your ordinary income, basically just your regular income. And then in box 2, you're going to have your rental income or loss. So your share of the profits in an investment partnership, real estate investment partnership, are typically going to be rental income or loss. And that's going to be reported in box 2. And then also your share of any gains will be reported in a separate box. I don't recall the number of that box off the top of my head, but it is on the K1.
Okay. And so what about the Class A members? What tax report do they get?
Yeah, they're almost always going to get a K1. And it's going to report their rental income or loss, and it's going to report it's also going to report their gains when that happens, when the property's sold.
All right, so we have our clients typically pay $1,000 for their Class B interest. Doesn't matter if the Class B member is a manager LLC or if it's the members of the manager. We want the Class B members to pay something for their Class B interest to establish an initial cost basis. Is that is that required?
So technically, it's not required. The IRS assumes that when you get the carried interest, or the profits interest is another term for it in the tax code, they assume that you didn't contribute anything to it. However, there's a few reasons why many people recommend that you do put put something in, even if it is as low as $1 or $1,000, and that's simply because now it officially establishes that the Class B members have an interest in the partnership. There's some cases where the IRS could argue or perceive that because there was no capital account, because if you didn't put any money in it, you don't have a capital account, that there is no partnership, or that you don't have an interest, or there could be arguments over the timing of when that interest was received. So it's very common to see people putting in some form of capital just to clearly establish without any discrepancy that there is a partnership there, where they do have their interest in the partnership. And
I thought I heard you say that they could put in as little as $1.
Yeah, I mean, it's just establishing that, like, hey, look, it's just like it's a formality pretty much, and that's about it.
Okay. All right. Well, great. So what I'm getting out of this is it's best if you guys pay something for your Class B interest. So we'll continue to advise that. All right. So let's talk about, so the structure we've been talking about so far is the syndicate structure. And now I want to talk a little bit about a joint venture or a member managed LLC. and what would be maybe some difference from a security standpoint if somebody came to us and said, we have 3 other investors and we're all going to put up money to be in this deal, or I'm going to keep 25% of the interest and the other 3 are going to put up money. From a security standpoint, in order for our clients to call that a joint venture, all of the members have to be actively involved in generating their own profits. So if all of the members of an LLC are actively involved, there are no passive members, how does that change the tax ramifications?
It really only changes it for someone who would otherwise, because everybody in this partnership would be a general partner by default.
Yep.
There is no carried interest anymore. It's just a normal partnership interest. So you're still going to be taxed at ordinary income rates on your rental income that would be received. And now the long-term capital gains rates on the sale of assets is achievable on just holding the asset for a year and a day. You no longer have to achieve, there's no worry about holding it for 3 years, because that's only applied to carried interest and not to or like just your traditional partnerships or your ordinary partnerships.
And I will at some point share with you anecdotally a nightmare story about being in a development project and the tax issues that arose from that. But that's a different rabbit hole.
Yeah. Just one more thing to add to that. So that's if you're holding a property for buy and hold. Now, if you are flipping a property or perhaps developing a property, that's when you can get into the situation that I described before, where it's considered inventory and not considered a capital asset. And then your profits from that are considered, business income, and you're taxed at the ordinary income tax rates in addition to the self-employment tax rates.
Yes, I've experienced that. Not happily, I'll have to say. Okay, so I think we talked about depreciation a little bit, but this question comes up all the time amongst my clients: can the depreciation be allocated to the members disproportionately to their ownership interests?
So the short answer,
wanted to give all of the depreciation to all of Class A, or maybe even just a subclass of Class A, could they do that?
the short answer is it is possible, but it's extremely complicated to do. And if it could cause problems down the line when the property is liquidated, where the people who were allocated or disproportionately allocated the losses could have to pay back part of their capital account if it goes negative to the partnership, depending on how it's structured. I mean, we could probably do a whole webinar on what's called special allocations, but long story short, it is possible. It's very complicated. If you're going to do something like that, consult your tax advisor just prior to doing it, because you don't want to put yourself in, you don't want to put yourself in a bad position where you have to pay back a certain amount of income out of your pocket, or you just have really adverse tax consequences down the line.
Okay. Yeah. Nobody wants to pay money back. So let's try to avoid that at all costs. I think we've talked a little bit about this. Next question was, is there ever a time that anyone should use a corporation to own real estate? And that's where you were talking about the S Corp. Well, okay, actually not. Is there a time that anybody should use a corporation to actually take title to the real estate versus an LLC or a limited partnership?
Generally, no. However, if you are falling into that flipping and development category, a common strategy is to hold title to the property in an S corporation. And that's because, again, that income can be classified as ordinary income and subject to self-employment tax. And by taking that title to the property in the S corporation, you're able to pay yourself a wage out of the S corporation and help mitigate your exposure to that 15.3% self-employment tax. So it's very common to see people who fix and flip and develop properties hold their interest either directly or indirectly in an S corporation.
Okay, but they don't use the S corporation to directly own the real estate, or do they?
So yeah, they would either own the real estate directly in the name of the S corporation, or they'd have a single member LLC that's owned solely by the S corporation that would hold title to the property.
Isn't there some rule that an S corp can't have any non-U.S. members?
Yes, that's correct.
Okay, so just be aware of that if any listeners are thinking about having some foreign investors. What about using an S corp to sell interests to investors? Is there ever a time that anybody would want to do that?
It is possible people do that. I'm not sure that it'd be the best structure for it, because with an S corporation, there is no so in an S corporation, if you buy there is no ability to do special allocations. Everybody, if you have an interest in if you have a 5% interest in an S corporation, you get 5% of the income and loss. There's no ability to change that. It's just very straightforward. Whatever your ownership interest is in the S corporation is what your allocation is, and there is no way around that.
Okay, well, that's good to know. All right, so before we go to Q&A, why don't you give us contact information about how people can reach you?
Absolutely. So you can reach me directly at thomas.castelli@hallcpallc.com, or you can visit therealestatecpa.com, and you can fill out a form to have a free consultation with us, or check out the Real Estate CPA podcast. That's how you can get in contact with me.
So I think I need to subscribe to your podcast. I've learned a lot today. I hope everybody on the call has learned a lot today. I will give out our contact information in case anyone has to drop off the call. You guys are all in our database, or you wouldn't have heard about our call. Our syndication attorney's website has a ton of information about deal structuring, and you can get a copy of my book there. In case some of you don't know, I did write a book called How to Legally Raise Private Money. It's a #1 Amazon bestseller, and you can get a free digital copy at our website, or you can buy it on Amazon if you want a soft copy or Kindle. And we do have an Audible version that we're working on, so hopefully we'll have that done in a little while. We also have a sister website called Investormarketingmaterials.com, and there you can see some of the types of investor marketing materials that we can help you create. I told people for years that they needed to have professional marketing materials written by professional editors and professional graphic designers. Couldn't find anybody to do it, so we finally created our own company that does that. So we have professional editors and graphic designers that can help you design professional marketing materials, including your websites, investment summaries, company brochures, educational programs, pitch decks, one-pagers. There's a multitude of things there. If you want help with branding your company, then you're just starting out in the syndication world and you want to create a brand for yourself, we can help you create that brand and then have it be consistent across your marketing materials. So do check that out, investormarketingmaterials.com. At either of those websites, you can schedule an appointment. We're happy to have a 30-minute conversation with you if you want to talk about how to get from where you are right now to where you want to be, or if you have a deal. And even if you don't have a deal, we do have a pre-syndication retainer where we can give you one-on-one legal advice and establish a relationship that would kind of get you from where you are today to where you want to go. You can also call us if you want to at 844-796-3428. That's 844-SYNDICATE, SYNDIC, and the number 8. So we are now going to go to some Q&A. We've got some questions in the queue. Some people have given us different, let's see. I'm not the best person at doing this. This is our first time with Zoom. So if anybody knows and can tell me how to get to the people that have raised their hands, I would love that. But I can see that we do have some people that have typed in some questions. Let's see. Rob says, hi Rob, is there any downside to using cost segregation? For example, recapture later if we exit a deal sooner than anticipated?
I don't think there's any downside to, so depreciation recapture is charged regardless of when you exit the property. So there's no downside necessarily when you exit. I don't see any real downside of the timing of the exit on depreciation recapture.
Okay. So then is cost segregation a good thing? Is it worth it?
I mean, I would say that our general advice is if you're syndicating a property, you're going to want to cost segregate the property almost every time. That's our general advice. You could speak to your specific tax advisors on it, but we generally recommend that our clients do a cost segregation study on every property they syndicate.
Great. Okay. Next question is from Laura Lynn. What if the investor invested through an IRA? How are the gains taxed? Still at the 37% rates?
Yeah, so the IRA, this is always a great question. So when you invest through a self-directed IRA, you are subject to a tax called the unrelated business income tax on income that's on the income that's called on the type of income that's called UDFI, unrelated debt financed income. Unrelated debt financed income, there's a complicated calculation to it, but long story short, it's the percentage of the income that is that's derived from debt financing. So for example, if you had $10,000 of rental income, let's just say, and the property had debt financing of 75%, then 75% of that income, so 7,500, would be considered UDFI. Now, generally speaking, you're not, in most investment partnerships, at least the ones I've came across, you're not going to have rental income in the first number of years. That's because there's usually a cost segregation study that's performed, or there's a value add component that is causing there to be a loss, and you're not paying any tax because there's no income. Most of the time, you're going to see the Ubit tax or the UDFI generated by UDFI on the sale of the asset. Now, that said, usually it's not material. Like, you'll still have a pretty good return on your investment despite this tax, compared to the other assets you can invest in through a self-directed IRA.
Okay, that's great. Thank you so much. Okay, so Jackson asks, are refinancing proceeds taxed as ordinary income or capital gains?
Refinance proceeds are not taxable, generally speaking, unless you take it in excess, unless the cash you take out of the partnership, if you have a partnership, is in excess of the basis, your basis in the partnership.
Oh, that's interesting. Good to know. And we usually recommend that any proceeds that are received from a refinance are used to repay the capital contributions of the Class A members. Any comments on that structure? Or that?
Yeah, so I'm pretty sure the reason why most people want to do that is so that the the Class B members can basically pay off, reduce the interest of the Class A members, and then the Class B members could continue to keep the property. So that's what some people do.
Or get a higher percentage of the remaining proceeds from cash. The other reason that we recommend it is because you are leveraging the property at a higher amount with a refinance, and you want to pay down your initial obligation of what you have to pay back your investors so that you don't come up short when you sell, if the property hasn't appreciated enough to pay back all those original capital contributions. If you have any kind of a preferred return and you do return some of the capital from a refi to your investors, then from that point forward, you should only be paying any preferred returns on the unreturned capital contributions. So what that means is that if you were paying 8%, somebody invested $100,000 and that you were paying them an 8% preferred return, they were getting $8,000 a year, then you give them 50% of their money back. From that point forward, you only owe them an 8% preferred return on $50,000. And if there's a split later on in the waterfall where Class B gets a cut, then now you've reduced your burden to Class A, so there's a bigger portion of that split available to Class B. So that's another reason that we like to have you do that. Okay, great. Thanks, Jackson. That was a good call. Good question. Rob asks, can a sponsor 1031 carried interest profit from Class B shares? No, absolutely. No. 1031, you cannot own, you can't 1031 exchange real property interests for personal property interests. So they're two completely different things. If you're trying to 1031 exchange, you have to have direct ownership in real estate if you're 1031ing from another real estate asset. So you can't use it in any way within your syndication structure. It has to be outside of your syndication structure. Anything you want to add to that?
Yeah. So if you were, so yeah, you can't 1031 partnership interests. So what you could do is if the general partner or the investment partnership as a whole said, you know, we're going to go ahead and do a 1031 exchange. You could 1031 exchange. So basically, the investment partnership, let's say the investment partnership was called ABC LLC. ABC LLC would have to sell the property and then buy the new property. So it would have to be the same partnership. It's possible. It just has to be the same partnership.
Right. So, right. And within that LLC that's 1031 exchanging its property, it doesn't matter. You can have whatever structure you want within the LLC that owned the previous property, as long as I think there needs to be some percentage of common members moving forward into the new purchase. Are you aware of that requirement?
Yeah, there's a technical rule. There's a technical termination of a partnership if more than 50% of the partnership's interest changes hands in any 1 year, the partnership will terminate and the partnership will cease to exist. So you just have to be careful with how many people you pretty much buy out, because sometimes people want out when they do when this type of thing occurs. So you just have to be careful there.
Mm-hmm. Okay, and we have had some clients that have actually done a 1031 exchange. So they went to their investors and said, hey, we have an opportunity. We have something else we want to buy, and we have a buyer for the property that we want to sell. So do you guys want to just roll forward into the next purchase? And the majority of the investors did, but a few of them wanted to be bought out. So we carried the original investors over into the new property and then re-syndicated the new property because some additional funds were needed. And then with the additional funds, paid out those investors that wanted to get out, but it wasn't more than 50%. So it was fine. Okay, great. Thanks, Rob, for that question. And thank you, Thomas. So Nathan asks, do you still get taxed if all your investment is from an IRA or self-directed IRA? I think we answered that, and the answer is yes. That with the Ubit, right?
I think maybe he's just, are you still taxed if your investment is an IRA or a self-directed IRA? But in this case, it's the same thing. A self-directed IRA is just an IRA. That's just, you're able to invest. The custodian of that IRA allows you to invest in whatever assets you want, pretty much.
So Evan asks, can you run through an example of Class B recognizing both ordinary income and carried interest income?
Yeah, so an example of that would be the Class B members receive a distribution receive an allocation rather of rental income, and then they sell the property before the 3-year period, and they then recognize interest. They recognize a short-term capital gain, basically.
So what is the difference between short-term capital gain and long-term capital gain as far as, is it a different percentage tax or?
Yeah, short-term capital gains are taxed at the ordinary income tax rates.
All right.
Whereas the long-term capital gains is taxed at 0, 15, or 20%, depending on how much income you earn.
When would be an example of when it could be taxed at 0?
I could let you know right now. It's a certain threshold of income. It's if you make I hardly ever see it, so I always forget the number. But it's if you make under $39,000 if you're single, or if you make under $78,000 if you're married.
Okay. And then what is the cutoff for the 15 or the 20?
So 15 is 15 if you're single. It's a $434,550. If you're married, it's $4,088,850, and that will change every year. It will increase slightly.
488,000, basically.
Mm-hmm.
488,000. Okay, great. Okay, thank you. Ralph asks, please discuss phantom income.
Phantom income.
So that's when the partnership receives income but doesn't make a distribution, and the income is then allocated to the investors on their K1, so they still owe the tax on it. That's my understanding.
Yeah, that's pretty much what it is. Because what happens is when you have a partnership or an S corporation, for the same case happens, if you're taxed on the income, your portion of the income that the partnership or the S corporation would produce, not necessarily what's distributed to you. So if the partnership doesn't make if the partnership earns $1 million and keeps the $1 million in the partnership and doesn't make a distribution, you're still taxed on your share of that $1 million, despite the fact you didn't receive any cash that year.
Or if the syndicator stole all the money.
Yeah, I mean that too. That could be bad.
Yeah, let's hope that doesn't happen to anyone we know. Okay. Let's see. Stan asks, what if a sponsor / manager receives an equity interest in lieu of fees? What if they receive no fees? Then is the equity interest going to be taxed at ordinary income rates?
It would just be part of the carried interest.
Part of the carried interest. So would there ever be a time that the IRS could argue that, hey, you need to pay some ordinary income tax on, some portion of these earnings because they were earned for your active role in management?
Well, that's exactly what the carried interest is.
Okay. So the carried interest, and again, that's just going to matter on whether you keep it for 3 years or short term or long term. But
right.
Okay, right, all right, and
Yeah.
It doesn't matter because you're always paying ordinary income tax on all earnings from cash flow.
Correct.
So okay, Stan, if that didn't answer your question, please type in a clarification. Jesse asks, what if someone withdraws their 401k with the COVID-19 exemptions? How will they be taxed when invested in a syndicate?
Yeah, so it's kind of two separate equations. So long story short, if you did the COVID-19 exemption, you could pay back, for the 401k, you could pay back the amount you took off the 401k. If you don't pay it back, then that distribution you took from the 401k is going to be subject to a 10% penalty plus your ordinary income tax rates. It's basically considered ordinary income if you don't pay it out. Now, the money you took and invested in the syndicate, that's going to be taxed depending on the distributions from the syndicate. So that could be taxed as ordinary income if it's rental income, or capital gains if it's capital gains income.
Okay.
It's like just two separate things.
Okay. Laura Lynn, follow up on IRA question. What rate are the Ubit gains taxed in the IRA?
They're taxed at the trust tax rates, which I don't know the full trust tax rates off the top of my head, but it goes from 0 to 37% on ordinary income. And 37% tax bracket starts at $12,500 of income. So
you're going to pay
pretty quick
on tax rate.
Yeah, and there is also capital gains rates too. And I'm pretty sure, if I remember correctly, it's also 0, 15, and 20. I just don't remember the rates.
It all goes back to how did you earn the income? Was it from cash flow or was it from equity?
Yep.
Okay. Okay, so we have another attendee that says, please discuss the scenario when a Class B member is comprised of several individuals contributing sweat equity, but solely controlled by one individual acting as a trustee for the Class B member. If that individual acting as a trustee allocates those Class B interests at the start of the deal, can he or she reserve the right to reallocate those individual Class B interests at their discretion down the road? Oh, okay.
I got to be honest, I'm not 100% sure off the top of my head on that. I'd have to kind of do a little research and poking around to get an answer to that.
Yeah, I don't think that's a tax question. I think that's more of a structuring question. Does your operating agreement allow you to do that, or your trust agreement allow you to do that? And then I think whatever distributions those Class B interest holders receive, regardless of whether it's before or after you change it, they're going to get taxed based on whatever distributions they actually received. It's not like the IRS is going to read your trust agreement or your operating agreement. They don't do that. They just take what's face value, what's stated on the K1, and determine whether it's ordinary income or long-term or short-term capital gain. So I think that answers that question. Okay, Ralph says, we've already talked about phantom income. So that was phantom. So Rob asks, is it common for sponsor GPs to put catch-up into their Ppms and deal structures? I will answer that, and I will say that I always advise that. If you want to know more about that, there's an article on our website called Class B Catch-Ups Explained. So if you go into the syndicationattorneys.com library and then look for the articles, there's one called Class B Catch-Ups Explained, and it goes through a scenario where you do take it or you don't take it, and you'll see that the returns that you end up getting are significantly different if you do than if you don't. And I've had some different clients run through that scenario both ways, and they've said that the change in IRR, or average annual return, to the Class A members is nominal, but the amount of money that the Class B members can earn is significantly more if you do the Class B catch-up. I've had too many clients that we used to structure them without that. We used to do just a preferred return to Class A and then a split. And I had several clients that said, we will never do that again because the investors made all the money, we made nothing. And they just said, unless we have a catch-up, we're just not going to do deals anymore. So they just only will do it that way. Any comments on that, Thomas?
No, I don't have any comments on that.
Okay. So Barry asks, is depreciation and recapture tax typically shown in the PPM pro forma?
That's a good question. I'm honestly, no, it's not as far as I'm aware.
Okay. And then why not? I guess, do you just not know enough about it to know, or?
I mean, because the depreciation recapture, that's, because you don't know how long you're necessarily going to hold the property for, and that's going to determine how much the depreciation recapture is. So as far as I'm aware, it's not in the pro forma.
Mm-hmm. I guess there's no reason you couldn't put it in there if you could predict it with any kind of accuracy.
The other part, and then, the problem is too, you don't know necessarily the exact value of the improvements that are going to go into the property, because the improvements, like if you're going to do a value add, that's going to be depreciated. And you might go in, I guess you could pro forma it. Yeah, I guess to your point, you could pro forma it, but I generally don't see that done.
Right. And we usually tell our clients you should do at least a 5-year pro forma, and then we like to see that they kind of imagine a scenario, a sales scenario. And you have to make a bunch of assumptions about what's the cap rate going to be at that time, and what's the NOI going to be, what's the sales price going to be, all of that stuff. And by then you would have an idea of what you'd spent in the early years on your capital improvements. So sure, I think you could predict that. Just need to make sure that whenever you're doing those kinds of predictive spreadsheets in your property information, that you list all of the assumptions that you made, and then have a disclaimer that says that it's possible that the assumptions we've made are wrong, which would change this entire scenario. So the only real guarantee in real estate syndication is whatever you predict isn't going to happen. It's going to happen differently. And so you need to make your investors aware that you're just making some best guesses right now, but they shouldn't be 100% reliant on that because things change.
Thanks for listening to today's show. If you enjoyed the show, please find us on iTunes and leave us a review. You can also email us at contact@therealestatecpa.com with any feedback or topic suggestions. We are always taking on new clients, and with the new tax laws in play, you really don't want to navigate this alone. Let us help you save money on taxes and with your accounting and CFO needs. To become a client, navigate to our client page at therealestatecpa.com and fill out a web form with as much detail about your situation as possible. Thanks so much for listening. Have a great rest of your week.